In just 2 years, American households have seen something extraordinary, an estimated $5 trillion in new wealth created, largely thanks to a handful of companies tied to artificial intelligence. 30 AI-driven stocks, from giants like NVIDIA and Microsoft to emerging players in chips, cloud, and software, have powered one of the fastest wealth booms in modern history. But behind the glowing headlines and record-breaking charts, a deeper question is emerging. How sustainable is this AI-fueled wealth surge, and what could go wrong next? Let's start with what actually happened. Since late 2022, the U.S. stock market has been riding a wave unlike anything since the dot-com era. The so-called AI 30, a group of companies driving, enabling, or capitalizing on artificial intelligence, have exploded in value. NVIDIA alone added more than $1.8 trillion in market cap in less than 2 years. Microsoft, powered by its OpenAI partnership, added another trillion. Alphabet, Meta, and Amazon surged as they embedded AI deeper into their products and services. Together, these 30 companies, spanning semiconductors, data centers, enterprise software, and AI infrastructure, now represent over 40% of the S&P 500's total gains since 2023. That means AI didn't just lift the tech sector, it practically became the market. And it wasn't just investors who benefited. As stock prices soared, household net worth in the U.S. hit record highs. Retirement accounts swelled. Index funds, which millions of Americans hold through 401ks, ballooned as tech stocks dominated. For the first time since the pandemic, household wealth was rising faster than inflation. In fact, Federal Reserve data shows that much of the recent improvement in household balance sheets can be traced back to rising equity values, and those values, in turn, are overwhelmingly tied to AI. It's a rare moment where technological innovation, stock performance, and public wealth have all aligned. But here's where the story gets more complicated. This $5 trillion wealth boom is highly concentrated. Roughly 80% of those gains come from just 7 mega-cap companies, the so-called Magnificent Seven: Apple, Microsoft, Alphabet, Amazon, Meta, NVIDIA, and Tesla. These firms have become so dominant that the rest of the market barely moves the needle anymore. That creates fragility. When one sector, or even a handful of companies, holds that much influence, the system becomes top-heavy. If investor sentiment shifts or AI profits disappoint, the fallout could ripple through everything from pension funds to the housing market. And there are early signs of strain already. Valuations for leading AI firms have reached historic extremes. NVIDIA trades at more than 30 times forward earnings, a level that assumes explosive, continuous growth. But AI hardware cycles move fast. A single generation of chips can go obsolete in a year. That makes these valuations risky because they're priced as if the current boom will last forever. Meanwhile, productivity data, the real-world economic measure of AI's impact, hasn't caught up to the hype. Yes, companies are investing in AI, but many are still experimenting, not yet reaping tangible returns. McKinsey estimates that only about 12% of large firms have scaled AI across their operations. The rest are in pilot stages, exploring use cases but not yet seeing meaningful profit impact. That gap, between investor optimism and economic reality, is where bubbles are born. And it's not just about numbers. There's a psychological dimension too. AI has become the narrative driving markets, much like the internet did in 1999. Or crypto in 2021. Investors aren't just buying profits, they're buying possibility. And that's powerful until the story breaks. We've already seen echoes of that in smaller AI names. Dozens of startups that went public during the hype cycle have lost more than half their value in the past year. Many promised revolutionary AI breakthroughs, but struggled to generate consistent revenue. This divergence between the proven giants and the struggling hopefuls is a classic late-stage sign of a frothy market. But here's what's different this time. Unlike the dot-com bubble, today's leaders actually make money. NVIDIA's profits have exploded. Microsoft's cloud business is growing double digits. These aren't speculative startups. They're industrial-scale profit machines. The question isn't whether AI is real. It's whether expectations have simply outrun what the technology can deliver right now. And even if the tech holds up, there's another looming risk: policy. Washington is increasingly wary of the market power these AI giants hold. The Federal Trade Commission and Department of Justice have both launched antitrust investigations into the partnerships between cloud companies and AI developers. Lawmakers are eyeing new taxes on stock buybacks and stricter export controls on advanced chips. Meanwhile, the Biden administration's latest export restrictions have already hit NVIDIA's bottom line by limiting sales of its high-end GPUs to China, one of its biggest markets. That shows how fragile the global AI ecosystem really is. A single policy shift can erase billions in market value overnight, and beyond regulation lies another growing constraint: infrastructure. AI is energy hungry. Data centers are consuming so much electricity that power utilities in states like Virginia and Texas are warning of shortages. Building enough capacity, in both chips and energy, to sustain current growth could cost trillions more. So while Wall Street celebrates AI as an unstoppable engine of wealth, the truth is, this machine runs hot, and it could overheat. If chip demand slows, if regulation tightens, if infrastructure lags, even slightly, the market could correct hard. Analysts warn that a 10 to 15% pullback in AI valuations could wipe out over $2 trillion in paper wealth. That's enough to dent consumer spending and cool the broader economy. But even with these risks, there's one undeniable fact. AI has already changed the structure of wealth creation in America. In the past, innovation waves created value slowly: industrialization, electrification, the internet. AI is compressing that timeline. Wealth is being generated faster, more digitally, and in fewer hands than ever before. That's both a technological triumph and an economic warning. The winners of this moment, the engineers, shareholders, and AI-driven firms, are shaping the next era of the U.S. economy. But as history shows, every boom comes with a reckoning. The only question is whether this AI surge will mature into sustained growth or become the next chapter in Wall Street's long story of euphoria and correction. For now, the $5 trillion miracle of the AI market stands as proof of America's innovative power and its appetite for risk. But the same force that made U.S. households richer could, just as quickly, remind everyone that in markets, as in technology, every revolution comes with a cost.